Just a little quick rundown on me. My name is Dwayne LeBlanc. I come from the greater New Orleans area. And when I hear you had this event in '06, you had this event in there, I say, welcome to my world, okay? Because I can sit here and go, Ivan, Ike, Katrina, Rita, Gustav, you know, and just keep going on and on. You know, it's like we have a 100-year flood every year. So, and then really that's a misnomer when people think of a 100-year flood, you know. It's basically a 1 chance in 100. So it's a 1% chance in flooding in any given year, provided you build to the elevations that the federal government has put out there for you. I'm going to read this because this was a quote that I wanted you to see on the screen. And it's a quote that if you've been through an Irene, or if you've been through a Lee, or a Sandy, or any catastrophe where there's been, it can be damage from flooding, it can be damage, you know, from, you know, it could even go back to the World Trade Center, it can go back to, you know, any major catastrophe which triggers assistance or triggers, you know, a lot of people, a lot of trauma to a large area, whether it's insurance driven, whether it's terrorism driven, or whatever. This is a statement that I read, and this was a gentleman's exit interview as he was leaving a position and basically going on to another endeavor or going into retirement. Not sure where he's going at this point. But I'm going to read this to you, and I want you to listen to what it says, because to me it's the concept of the whole thing of what he says that is the focus of what risk management has to think when they're thinking about flood or any catastrophe that they might consider. I mean, catastrophe can be pandemic flu. I mean, it can be a windstorm event. It can be, you know, anything. So this is what he said. Now you have to rethink the world and rethink how you build buildings. Rethink where you put buildings. Rethink your supply chain if you're a business. Rethink where your plant is, where your office is, and rethink where you are. And rethink all of this stuff if you think the world is different. That, when an event happens, is where it leaves us. It has us rethinking all this stuff. And he's concluded it, and if you don't think the world is different, then I have a bridge to sell you. Okay? I want you to understand that. That's the concept. We learn from every event. We understand. FEMA learns from every event. I mean, I know there's stuff that's been done in Sandy that developed out of Katrina. People may have heard of these advisory base flood elevation maps coming out on the Jersey Shore, and they'll be soon making their way into New York, okay? And these maps have been used, a new technology called risk map. They've been able to develop these within 60 days from the event, whereas really they didn't have the technology to do anything like that for the most part in Katrina. They had a model. It was more of an antiquated model. It wasn't the detail level and the digital level that risk map now brings from a federal government standpoint. So literally within 60 days, they can advise a community that if you want to mitigate your risk, you need to do this and this as far as building height-wise and types of constructions and types of risk and type of hazards that you go. And you'll learn a little bit about all those different things as we go through this, we hope. Now here's the clicker. I have to give credit where credit's due. So don't kill the messenger. Just understand the message. The gentleman that said this, he is Willis's Joe Plumeri. So don't kill the messenger. I want you to understand the message I thought was right on, and it's appropriate anytime we come out of a catastrophe, and it's appropriate anytime our industry or their industry makes a change. I mean, we're going through a lot of things as a country, and we've just had debates on fiscal cliff. Now we're having debates on debt ceilings, and if you don't think that changes the world, then I guess I got another bridge to sell you, okay? I want you to understand that's where I'm coming from when I talk about these things, because I'm looking at it from a risk management standpoint. We're going to go into some NFIP considerations today. We're also going to kind of go over public assistance, which is basically governed under the Stafford Act. We're also going to look at some private considerations and then wrap it up with other considerations that might impact us. This is just going to be pretty much moving through some detail to help you. There's some significant detail that backs up all this information. We could give a talk just on public assistance and spend a whole day on it from that standpoint. I want to just kind of get an idea. How many of you guys in this room were affected by Lee? Okay. How many were affected by Irene? Some of the same hands, a few new ones. Okay. How many have actually been affected by Sandy? Okay. So you guys will keep putting your hands up. Y'all just in a bad place at the wrong time? Is that what it is? How many of you were blessed by God, okay, and hadn't had to deal with any of those kind of events? Anybody? A few of you, okay? My next question is, for those people who have been affected by Irene, Lee, or Sandy, how many of them will do what they did the same way for the next event? I don't see any hands. And so my statements that was made by the Willis head is right on. It's different now. We know more. We know it's different. We know how things react. We also know too how our contracts reacted and where we need to go. So let's move forward a little bit and let's start talking about the NFIP first. The NFIP, why was the NFIP established? Most people understand the NFIP was established in 1968. It was established really because there was no alternative for people to privately insure the risk of flood. The other thing it was also established is to also establish basically a floodplain management strategy for this country, because in order to become in this program, you have to do certain things from a code enforcement standpoint in order to even participate in the program. So it's a combination, and any successful, whether it's here or whether it's across the oceans in Europe or in Asia or whatever, any successful flood strategy combines the two. It combines some form of insurance with a full-fledged mitigation or floodplain management program. You can't do one without the other, because that risk is just going to compound itself if you do nothing on the mitigation side and all you do is insure it. So, and then as you go, when you look at your own casualty and your property risk and stuff, it's always combined with insurance and a loss control program. So that's your parallel, is basically those same types of things. We want to talk, and that there's two arms of the flood program. You've got the federal government direct, and you got the WIO companies. We're both selling the same policy. We're both selling the same policy forms. We're both selling under the same program rates and rules. However, the WIO companies are under a subsidiary arrangement made with FEMA for companies to service that program for them at a fee. And they basically operate it under their paper, and then the government basically backs that up with that subsidiary arrangement. We have no dollars at risk except the risk of managing the expenses and the cost of doing business versus the revenue we get paid under that subsidy arrangement. But basically, the WIO company and direct are the same. You have one layer in the direct which also addresses mitigation, which was the federal government handles it directly, and it's called the severe repetitive losses. The government wants to handle those directly so they can target mitigation and pull some of those out of the program at a later date with communities. Where the program is only offered in participating communities. And you need to understand what a participating community is. And I look at it as, these communities make a decision on cost and benefit. And what they look at is it costs them, the benefit they're hoping for is insurance, and to be able to offer insurance for flood insurance to their constituents. The cost of doing this is their portion of it. Of course, there's mapping involved, and based on those mappings, there's laws that get paid as far as code enforcement, and as a result of code enforcement, there's inspections and policing that have to take care of. So what happens is the community makes a decision, for the benefit we get of the insurance program for our constituents, is it worth us to share in the cost of mapping? Is it worth us to share in the cost of passing a law or an ordinance, which now I have to now enforce by law, stating basically that if you're in a hazardous area, okay, you must at least build to this height. So now I have to have a full-blown inspection department that accepts that permit, makes sure that it's in compliance, and enforces that law. So my cost is all in regulatory and in mapping cost in ordinances, okay? Whereas the benefit is the insurance program. If I'm in New Orleans, Louisiana, my hometown, you look at the cost and you look at most of the areas below sea level, you say, okay, is the cost worth the benefit? And you look at history and you say, well, yes, it is, okay? So that's an easy decision. But if you get into an area like which I experienced in the early 2000s, I was thrusted into Tuscaloosa, Alabama, and working that area as a regional rep. And the city of Tuscaloosa participated in the program, but the county didn't. And so you begin to go, well, why did the city and why didn't the county? The city made their independent decision as a community and decided not to make that decision. Made that decision because they thought the cost in that would benefit the members of people there. Well, at that point in time when the community made the decision, the county made the decision, the county looked at it and said, well, we're mostly farmland. There's very little property out here, that type of issue, and they said, well, we don't want to participate in this thing because it's actually going to cost us more to police it than what it's going to cost us and give us in a benefit. Well, as time went on, and Tuscaloosa, the city, started to spread out into the county further and get into the unincorporated areas of the county, they revisited that decision and later on made the decision that, wait a minute, we now have runoff we didn't have before because there's development out here. There's more people out here. What used to be held in the cow pastures, the water, is now running into the streets and possibly threatening homes and that type of thing. So now they looked at the cost and looked at the benefit and said it's worth our while to regulate building so we avert loss in the future, and it's also worth our while to go ahead and bring the insurance thing. So when the community decides that the benefit outweighs the cost, they participate, and that's usually your participating community. If they don't participate, they just simply make the decision, this isn't for us, and it's a non-participating community. The reason I make the distinction is you understand this is part regulatory and part insurance, and when I'm a risk manager, I'm going to look at it more so, okay, what does this mean to me from a risk standpoint? And he's going to be looking more at the mitigation and the regulatory and that type of thing. Now, how do I handle that risk? That's when the insurance mechanism will be triggered, okay? But his first focus is what is my risk and how do I want to handle it? Whereas when he's looking at the benefit of it is, okay, is this cost of this benefit going to be worth me to make this investment over here to mitigate that risk? So I want you to understand, it's only on the federal program, it's only available in those participating community and not in the non-participating community. So that's your avenue when you can use that. And that's the biggest thing that we want to do. You've got to, when they come into the program, and I'm going to start using the chart then, basically what they do is they first do what they call an FIS, which is a flood, and I don't know if you can read this because I'm going to say what I'm writing. Flood insurance study. Okay? The FIS basically is, they're basically determining what is their risk of flood. Okay? And they're laying it out. Once they get beyond the flood insurance, they start creating what they call as a flood hazard boundary map. And they're looking at this the whole time. Once they go to a flood hazard boundary map, and then they begin to adopt what the federal government calls a FIRM. A FIRM is a flood insurance rate map. It is the final thing that they do when they get through these stages as they identify risks. On that, it will be different flood zones, and on that will be different elevations of base flood. And when I define base flood, it's 1% chance of flooding in any given year. So I want you to understand is that if I build to this level, I have a probability of 1% chance of any given year, okay? So that's what I'm looking at is probability there. If I'm in the non-hazardous area, I have basically a 0.2% chance of flooding in any given year. And we're going to define this a little bit further. But when they go through all the process, they ultimately adopt the firm. And when they enter into the program, it is that date that firm is accepted, or the firm date is which governs it. So most communities that participate in it came into this on 12/31/74. Okay? So anything 12/31/74 is considered pre-firm. Anything after 12/31 is considered post-firm. Very important, because if you remember, we're talking mitigation. So it's not any rocket science. It's before the flood insurance rate map, pre, post, after the flood insurance rate map. What happens is when they make that accept that firm date, that local community is now saying from this point on, I will start regulating construction in hazardous zones that it will at least be built at base flood elevation or higher. So what they're saying is anybody that's in a hazardous zone is now going to have to at least build to this height, and that height is base flood elevation. Okay? Anything before that date was totally not regulated. You know, I could build off the ground 20 feet, I could build under the ground 10 feet, and nobody cared. When it went to the permit process, they didn't ask me what was my elevation and what was my proposed elevation and what was I being regulated to. Okay? I want you to understand it. Now, 12/31/74 is when. If you entered into this program at a later date, and let's say 1/1/80, just using that as an example. If I enter the community, that now at a later date, that I compare the two really, 12/31/74 versus 1/1/80, whichever is the later date becomes my firm date. So really the entry into the community and when that firm's established is what determines. So anything before 1/1/80 in this community is pre-firm, anything after is post. So when you know the firm date, you know I got property that was not regulated according to heights for flood, and I got properties that were regulated as far as flood insurance is concerned, or the floodplain risk plane management. And I clarify that so that you understand what's regulated. Why? If I got a building that was built before and it's in a hazardous area, do I really know where its risk is? What is its probability? It might be 20%. Its probability might be less than 1%. We really don't know. So you're clustering all those properties in that pre-firm category, and it's carrying a rate that's commensurate with that full risk of not knowing. Okay? And the government calls pre-firm properties subsidized properties. Okay? So the government says, here's the rate, but we're subsidizing that. And if you've been listening to the news and all this with the new flood reauthorization, this Bigger Waters Act is saying we are no longer going to subsidize the federal program. That's where we're talking about. That pre-firm rate on standard rated policies is going to no longer get a subsidy rate, and it'll be phased in over the next 4 years at a maximum of 25%, and any maximum in 25% in the next 4 years. So I want you to understand pre versus post. Regulated, I think of it regulated versus non-regulated. The government later on comes back and does a map change. So now I have an historical if I'm looking at it from a risk management standpoint. I know if it was built, let's say my map changed, my original map was 74, everybody with me? My next map is 1980. I know that in 1974 they were saying I had to be in this house, this particular property that I'm looking at had to be built at a 10-foot base flood elevation. I know if that community did their job, that risk is at least at 10 feet, correct? If it's now 12 feet, then I know what my risk actually based on the latest information has gone up, okay? So it helps for a risk manager to understand, says, okay, here's what you built under, but here's the new floodplain based on the latest, greatest data that FEMA has put out, and that's hydrological data. They use the U.S. Army Corps of Engineers and their own engineers in that. In fact, that's the same technology risk map that I was talking about earlier, okay? And I want you to understand it. So when I know that there's different construction dates and there's been different maps, I have a historical perspective of how that risk has changed in floodplain over the years. And as a risk manager, that's something I might want to know. Okay? Another example of that is, what if my heights actually went down? Okay, well, my risk just went down. I was making a risk management decision that I'm going to insure everything that's at 1% chance of flooding in a given year. Well, if my base flood dropped 2 feet, am I still at a 1% or am I at a lesser percent? Okay, I'm at a lesser percent. And so therefore, I might want to know that based on my risk management. I may make a decision to not insure that. Or I may make a decision to insure it in a different manner. I could also, and we'll talk about it in a little bit, I could also maybe say, hey, does this qualify for a MAP amendment, a letter of MAP amendment? Which means that I give government information about this specific risk, and with that information they take what I just said and say, hey, wait a minute, it isn't at a 1% and it's at a lesser, so they may reclassify it based on base flood or based on zone. But I will talk about letter of map amendments in just a little bit. Zones are very important. I'm going to do it this way, and it's the easiest way for me to do it, is if it starts with an A or a V as in Victor. That's the easiest way for me to teach this without giving you a specific list of all these. It is considered an SFHA, which is Special Flood Hazard Area. Okay? That's the easiest way for me to do it. I can read all these things, but there's about 10 of them, okay? However, if it is a B, C, or X, is this or? Come on, Dwayne. Everybody's got that gist, right? That is a non-SFHA. That makes it pretty, non-special flood hazard area. If you're in a community that participates, this is a myth that a lot of I'm not in a flood zone, but I'm telling you, if you're in a community that participates, you're in either these or you're in one of these. So my answer to you is, if I'm in a participating community, am I in a flood zone? The answer is yes. It's just whether I'm in a special flood hazard area or I'm in a non-special flood hazard area. Different degrees of risk. You've got a moderate or a minimal degree of risk. It doesn't mean you don't have any risk, okay? You have a minimal or a moderate risk is what you have. So you have some degree of risk. So as a risk manager, I have to make a decision what degree of risk I want to absorb, what degree of risk I don't. Or as you are familiar with other property forms is, well, how does my property form react when I'm in a special flood hazard area versus a non-special flood hazard area? Everybody's okay with that? And we'll talk more on other considerations when we get there. I want you to go a little bit further with this. If I'm in a AE or a A1 through A30, my risk of flooding, that tells me what the risk is, where it's coming from. That risk of flooding is rising water. It's usually something like rapid accumulation, something that happens from the ground up. So if I understand my risk is from the ground up, I also know how I can mitigate that. Okay? So I want you to understand, when I'm looking at AE to A1 or A30, I'm talking about rising water. Okay? I'm not talking about movement or anything. But by the same token, if I'm coastal and I'm VE or V1 to V30, that's a V zone, and in V zones what we have is water that is subject to motion. It can be tidal surge, waves. It could be on a river batcher. It could be that as the spring comes up and the river comes up, I now have a flow that might come. It's moving water. A lot of people like to say these are the velocity zones. The water has movement. It's another way of learning it, okay? So if I understand construction-wise and risk management-wise, my risk is coming up this way. How do I mitigate the risk? It's probably raise my building, okay? Or move it out of there. The other one, if it's movement of water, where does my risk start? It starts at the first point that gives me resistance to movement of water. So I got a building that's built up on stilts. I'm going to use that as an example, okay? It's up on stilts. It's got an I-beam. Everybody with me? Has an I-beam. If it's rising water and my beam gets soaked, has it really done any damage to my building? No. So if I'm in an AE zone, my real risk of flood starts at the threshold of that first floor that's off the ground, correct? If it's movement of water, if that water hits this lateral beam, where does my risk start? It starts at the bottom of that beam. So you have to understand is where is it starting? What is it taking place from that standpoint? So that I know how to mitigate it. If I raise this up enough to get that beam above what is the movement of water, then I minimize my risk. Same thing is, all I have to do is worry about in a rising water situation to get that one above there. We also have some other zones which are AO zones. And an AO zone takes into consideration that I might be on a slope and water comes through my property. They call it runoff, okay? And it's going to settle down in the valley, okay? And usually what you see in those, you don't have a base flood elevation you have to build to. You have a base flood depth. And what that depth is okay, I have to build 2 feet above my lowest adjacent grade. So that when the water runs down, instead of going into my property, it runs around it. There's enough depth there to thwart it based on the 1% chance of flooding in a given year. Okay? Then we get into an A99, which is a lot of people are not familiar with. What you need to know there is A99 says to me is that they are currently working on some form of mitigation project, and at a later date, they are going to reclassify that area once that project's done. So it's a mitigation project in action, and there are certain heights that they require, even in an A99. However, when we rate it, we don't use that height because it's really just an A99 flat rate for that area under construction. I'm telling you this so you at least understand where the risk is coming from. When we get to B, C, or X, B and C, let me just real quickly go through this. As new maps come out, this is being eliminated, and they will all be this. This is being eliminated, and they'll all be that. Right now, you're dealing with transition, so you have some with A1 and A30 on them, and others with AE, okay? You won't have both of them on the same panel. Because when they go to the new firms are digital, and as a result they're combining zones so that it doesn't confuse us as much. We were working with so many different zones that it was much easier to bring them all into one classification and establish a height for them to build to. These will still be here. The B and C's here, which are your non-hazardous areas, your B and C's are going away and becoming X. But there will be a shaded X and an unshaded X. And that mirrors the B and the C. But it's important that a risk manager understand this as well as this. When he's looking at B, C, or X, if I'm thinking B, or if I'm building in an area that's B, what I'm building is in an area that has less than a 1% chance of flooding. Remember we said 0.2% chance of flooding, a minimal risk of flooding in any given year. However, the probability of a B is altered by the fact that there's some form of mitigation that's making it a B. If you look at my area where I come from, it's the levees around New Orleans that are making it a B. Okay? A C says, even without that mitigation, and I'll use the same city, because most people know the French Quarter of New Orleans. If you don't, it's where the church is every time they show New Orleans. The big picture of the cathedral that's there, okay? And that area is so naturally high that we could knock all the levee systems down and it's still in that minimal risk area. So understand that a C is naturally high enough that it's got a low probability. A B is got some form of mitigation that is lowering its probability to that tolerance level. And then your shaded X and your unshaded X are similar. Your B is parallel to a shaded X. So if I'm shaded X, I'm just like a B, meaning there's form of mitigation out there that's making me that. If I'm a C now, when it gets remapped, I'm probably going to be an unshaded X. Okay? Everybody says, well, why didn't they do it? Rating purposes, X's are the same, no matter whether they're shaded or unshaded. But from a risk management standpoint, if I'm writing a piece of property along the Mississippi River, and I'm the Diocese of Lafayette, okay, which is out of Lafayette, Louisiana, and they're opening up the Morganza Spillway, because the river got unreal last year, if you remember, because there were problems all along the Mississippi River with flooding, okay? Understand that that risk manager is now sitting here saying, well, maybe I should have bought that B zone property when I made a decision only to do the hazardous areas, okay? And if he knows that that is a mitigation piece, he will look at that differently than he looks at it otherwise. And then from a banking standpoint or lending standpoint, he's also looking at it from this standpoint that he can't discriminate as a lender. The government says under mandatory purchase, and I'm just going to put mandate, okay, because I can't fit mandatory, that if you have any federal direct or indirect lending on that property, you must carry flood insurance on it, okay? Doesn't matter whether it's personal or commercial. You must, okay? There are some banks, and if you were a local bank and you were doing mortgages in the greater New Orleans area, would you just go with this mandate or would you expand it to include these as well? And a lot of them will make this decision. They can go further, as a bank can go further than what the mandate under the federal law is, because it's their portfolio, and if you want to do business with them, you got to abide by their rules. However, they can't discriminate. So as a result is, they might say, we want this and all the shaded X or the Bs. Or they could say, we want the whole 9 yards. It gives them some fluctuation to take care of situations like my hometown, okay, and pick up more of that without discriminating, okay. Bank of America is a good example. Bank of America does nothing but the mandate. Why? Well, when I got a property that's way up on the top of a bluff, okay, and the chances of flooding are slim to none unless Noah's Ark creates itself again, okay, then I want to still be competitive nationwide on mortgages like that. So as a result, Bank of America is only going to do the federal mandate. But if I'm a local regional bank, I'm going to look more at my local portfolio. I don't have as great of a spread of risk as, say, a Bank of America has, so I may expand this to pick up more risk. The reason I went through that analogy is take the lender's thought process and say, can a risk manager think like that as well? He can say, I want to do this because of this, and what we want him to do is make a risk management strategy on how he wants to handle this. Is everybody okay with zones and what they mean? If you hear somebody say they're not in a flood zone, can you tell me what that means? I'm going to tell you what the layman thinks it does and what most agencies think. This is what they think right here. Okay? When they say they're not in a flood zone, what's happening is the bank has done a zone determination, and they say they're not required to flood. Big misnomer, because this is what they're driving their business decision on making purchases of flood, and this is also what their risk is. So we need to understand that, hey, while they say no flood zone, the biggest thing that you got to make sure that they know is flood insurance, if it's a participating community, is available. If it's not available, it's a non-participating community. And if you don't put that it is, you can go ahead and set it up behind me. If you don't know what it is, then You need to understand it, because that risk manager is going to make a decision based on what risk he wants to retain and what he doesn't, okay? Letter of map amendment. I think of a letter of map. Remember we said that they develop what we call a FIRM, right? Which is a flood insurance rate map. Everybody with me there? Okay? If my property is here, and let's say my property is zoned in an AE zone, a hazardous zone, with a base flood elevation, that's what BFE means, of 10 feet. And that's 10 feet of MSL, okay? Well, this map was done with certain assumptions and done based on a full flood plain, okay? I'm going to use this as an example. The developer in this, my lot is, took this whole development and added 8 feet of fill before he developed it. So the firm was based up here. He later on development, that whole development got 8 feet of fill since that map was done. Okay? And let's say it settled down to 6 foot by the time it settled. Okay? So now, instead of my property being at the grade it is, it's now 6 feet higher. Well, when I go ahead and I put a building on it and that type of thing, I may already be above this 10-foot mark. This additional information here says that the risk that's here for this zone is not the risk for my property anymore, because my lowest adjacent grade is now higher than the 10 foot. Okay? So I'm just going to go through that real quick and then you'll see what I'm saying. So I got my building, okay? It's my easiest way to do this. And you always on a building usually have a highest adjacent grade, they call it a HAG, okay? And you have down here a lowest adjacent grade, okay, because the street's out here. It's going to drain usually from front to back. It's very rare that those are the same. Usually have a highest adjacent grade and a lowest adjacent grade. So what he did is he built, so I'm going to tell you that my 10 foot is here. So that's my BFE, which means it's below base flood. What I told you base flood was a 1% chance of flooding in any given year. Since he filled it and now I built, let's say my lowest adjacent grade is 12 feet, just to use that as an example. Okay? If my grade's at 12 feet, is it at a greater or lesser probability of flooding at grade than it was at 10? It's less. If I give the federal government, wait a minute, my property is got a lowest adjacent grade here. My slab's now at 14 feet, just for, argument's sake. So I'm 14, 12, and 10. If I present that to the federal government, they review it. And based on the information, just like you agreed, that the risk has been lowered, it's less than a 1% chance of flooding in a given year. So they say, we're going to issue a LOMA, which takes you from an AE to an X. That is, in its simplistic form, what a LOMA is. It's application to the federal government that there's some additional information on this particular parcel which says it's better than the BFE, or it's better than a 1% chance of flooding in a given year. So I am taking it out of that. They do it by a letter of map amendment, and the reason they do it by a letter of map amendment, it's so costly, excuse me, it's so costly to republish a firm for one particular piece of property. So they issue a letter out instead. So it's effectively taking it and saying, based on the information presented, your risk is now this, and we're going to amend the map through this letter.
Surveyor?
Okay?
Who does that, like a surveyor?
It's usually a surveyor can do it. It can be a surveyor and an engineer. Everybody heard the question, who does it? A surveyor? I mean, a surveyor. A surveyor can do a simple one like this, where it's just my lowest adjacent grade and my house, or my property are both above base flood. But when I get into the MT1 firm, it's a lot more engineering data involved. We've had some done coastally, and let me tell you, it even can take in consideration not only the environment of the property, it can even look at what the the subshelf is and what happens from, does it, is there a sandbar out here that separates the water before it comes in? It can be very engineering technical, okay? But basically, it's a LOMA, a letter of map amendment. Everybody with me so far? Any problems so far? Go ahead.
Why is that different than just an elevation certificate?
An elevation certificate is shooting the property itself, okay? And then giving you, this is the height of that particular property, and then it gives you the current flood insurance rate map information. It is not asking the federal government to amend their firm. It's just telling you, as of this date, this property is elevated to this amount, and the current flood map says that this is the current zone and the current base flood. So it's only giving me a static piece of information. Now I can use an elevation certificate in the very easy one I do. That's one of the requirements is a current elevation certificate and a little small, it's called an MTEZ form, which actually I have filled them out myself before and then got it out. And that's an automatic rubber stamp. When your LAG is higher than base flood elevation, you can use the MTEZ form and bring it out of it. So one, you're requesting the government to change the zone and reclassify the property. An elevation certificate is giving you static information based on the current map and the current things that they've shot on that particular property. Did I answer your question? I still see an inquisitive look.
It just seems that the higher you are with that elevation, the lower premium you get anyways. Isn't that the same result that you're looking for?
Could be. Could be this, okay? And let's use our product, okay? And correct me if I'm wrong, Doug, okay? If the product says, my other product in the federal government product, okay, says that I will give you a $25,000 deductible and give you $1 million aggregate if you're in one of these zones. You with me there? Okay, so if I get a LOMA on this property, I've shifted the burden from the A and V zones, which says I have a $500,000 deductible on building and a $500,000 deductible on contents before I get to my aggregate, or before I get to my limits, okay? So, wrote on myself. That just got on tape too. But you understand, why might I want to do that? Also, too, under the federal program, I can rate this under the government's PRP rates, which are usually lower, as long as it's had no more than one loss, okay, which are usually lower than these rates. So yes, you would achieve a lower rate the higher your elevation is. However, you may have better results for excess flood insurance, for corresponding property and its triggering mechanisms, and from that standpoint. So it's very important to understand this. And and correct me if I'm wrong, I'm trying to understand a product that I've been introduced to, okay? And these have to be filed in order for the trigger to go from an A to V to a B, C, or X under our product. And Doug, I'm relying on you to correct me if I'm wrong. It has to be filed before the event. We're not going to honor it after the event, okay? While the federal government says we will honor it and bring it back to on the event, okay? So FEMA will accept the LOMA and trigger coverage from the and make it concurrent, truck coverage concurrent with the event, whereas your private carriers usually won't. They're going to say if you get a LOMA after the event, that you're stuck with the zone that was in effect at the time, not when that LOMA was certified. So very critical about, hey, what our timing is on here, okay? BC or X zones, like I said, the easiest thing when I look at these and I'm going through elevation certificates and I'm looking at a portfolio of policies for flood, the first thing I'm looking at is where's the base flood in reference to the lowest adjacent grade. If I got a lowest adjacent grade higher than my base flood, I'm saying these are candidates, okay, and these need to be applied for. Anything else is going to require a lot of engineering data, more than just that. Did that answer your question better? And pull you full circle now, huh? Okay, good. LOMA, just so you know, It's a letter from DHS or FEMA stating that the existing structure or parcel of land has not been elevated by fill and would not be inundated by the base flood. Okay? So it's natural lay of land, and what we're saying, here's base flood, it's not going to be inundated by base flood. So the water level gets to here, right? That definition is what's applying. If my lowest adjacent grade is here, and this is the water level of 1% base flood inundation, I'm not at risk, so they say, and this applies. So that's what a LOMA is. It's not elevated by fill. The LOMR is actually the official revising of a current map to show the changes of floodplains and elevations. So when you make the letter of map amendment request on a specific property that's not, I'm applying for a LOMA, and then when it's issued, it comes out as a LOMR, and then there's also a LOMR F, which is the one example I had based on fill. So you got natural land and you got fill and that. Now, you will see CLOMAs, CLOMRs, and CLOMFs. Okay? Those are basically properties that are proposed construction. So you're actually asking for a change in the mapping based on that this is what you're going to do. Okay? These are actual, the ones that we deal with mostly are the ones where they're actually have been put in place. But if I was a developer and I was going to develop a particular, let's say I was going to go in, I was going to build a university, and we're going to move a campus from here to, you know, from outside of Albany into one of the surrounding communities. Okay, I don't know the area well enough to tell you what, but we're moving it out into one of the communities, and we see that. Wait a minute, some of this is in the floodplains as far as hazardous areas, some of it's in the non-hazardous area. We are going to go, and we're going to go first, do pre-construction work and apply for this, and this is how we're going to bring it, and we're going to try to bring everything out of the 1% chance of flooding in any given year. I make that under the CLOMA or COLMRF, or whichever one. It's probably the F in that case because you're doing fill in most cases. So you do have this whole process, and it becomes very integral in how a risk manager would look at his portfolio. So if he has the elevation information, if he has other engineering information that he might be able to get, he would then use the more technical one. Okay, we've seen more of the MTEZ, which is that simplistic one where it's readily identifiable right off of the certificate. Any more questions on how LOMAs? Yes, sir?
Yeah, can you just repeat again what LOMR is?
What the LOMR is? It's the actual official revising of the current map to show the changes. So it's been issued, certified, and now my property's been, used to be at an AE of 10, now the letter's been, they issue a LOMR, which is the actual letter of map revision, and it states on that letter that this zone has been moved, prior zone was this, current zone will be X. Okay? Any other questions on that? Any questions so far on NFIP type considerations?
One quick one. On
Yes,
that
sir.
LOMR, you said that the government would go back and use the date if it was prior to the event, and then you said that carriers wouldn't. What is? Are you talking like when you're writing excess or?
It could be.
In other words, what I'm getting at.
Okay, I'll answer this question this way. I'm going to use an example that came out of Hurricane Ivan, and I'll answer it from the government side. Then I'll take my example and tie it in that if this were a governmental building, what it was. What we had in this was in an area of Gulf Shores, Alabama, and what we had was a structure that looked like this, actually looked like a two-story structure, but it had a stairwell that went all the way up, had a garage over here. It looks more like Long Beach to me now that I've been working Long Beach so much, okay? And it had up here, okay? This was in an AE zone, okay, from that standpoint. And I don't remember what the base flood was, but it was in an AE zone. And what the government said in this particular claim that we handled is this building had up here, where the door was, up here was the kitchen and all the living area and that. All I had down here was basically like a finished room, okay, and a garage over here. The government made the statement in this particular case that this building was intended to be elevated. If a building's elevated under the federal flood program, you have limited coverage here on that elevated, on that below the elevated floor. Meaning, just use the contents piece as an example. we don't cover contents below an elevated floor. We only cover 3 items below an elevated floor and contents. It's a clothes washer and, actually it's 4 items if I put it this way. Clothes washer and dryer, okay? It can be a freezer with food in it or a portable air conditioning unit. So the government said this was intended. The contention was here, our contention was it was a slab on grade, and we couldn't get around that argument. But when we looked at it, the lowest adjacent grade, I'm going to have to give you a base flood, let's say it was 10. Lowest adjacent grade was at 12, and this was at 10, okay? So Ivan happened, adjuster went out, adjuster sees this, limits the scope of coverage, and the claim's basically closed. Except the insured saying, wait a minute, this is not an elevated structure, this is a slab on grade, this building is totally supported by its slab foundation. It doesn't have foundation footings or solid perimeter walls or anything that's supporting it on the exterior with poster columns in the interior. It is totally supported by the slab, and the weight is distributed across it, okay? Well, rather than arguing this, okay, I saw the bulletin where it said that we could apply for a LOMA, and if it's approved for a LOMA, it would trigger coverage back to the date of the event, which was the date Ivan happened. So I see this, and that the insured goes, let your mind, he was getting charged about $1,266 a year, okay? The insured goes and applies for LOMA based on that the lag is higher than the BFE, met the definition that it was inundated. If you're inundated at BFE, I'd still be above it, right? So we got the LOMA, and this was moved to an X. X has no limitations of coverage on the entire structure. It was easy to go for the LOMA than to argue my head on intended, okay? So since it got changed to an X, that September 04 is when it was. I'm trying to remember my dates. These dates are so many now. But September of 04, it went back to the that date of the event. It was an X, so we had no limited scope of coverage, okay? Now let's take it from, if this had excess insurance on this building, meaning over and above the $250,000. So let's say the building was worth $1 million. He's got $750,000, and it had a clause in it that said, we will only do it per what the zone was in effect on it. We will not honor LOMAs that were gotten after the date of the event. So in this case, my excess, while I'm paying no limited scope of coverage, the excess is paying a limited scope of coverage. Does that example help you understand what you're saying there? Everybody's okay with that? It's just, the fun part about the government is the current premium on this X zone, because it says you have to be in a BC or X zone in order to qualify for the PRP, right? And you have to have, you can't have 2 losses or more. If you have 1 loss, well, the only loss they had was Ivan. So now their current premium is this a great country or what? $412. So the guy got everything covered. If they'd have kept their mouth shut and just did it as what it was, which was truly a slab-on-grade foundation, we'd still be collecting $1,266. Instead, they gave us this provision, and now he gets put in an X, and guess what? We're getting $412 for that same, for all that coverage. You know, be consistent. But anyway, that's just one of my favorite examples to give. The same thing would be true whether we're talking a commercial building or, you know, or a, because a lot of the buildings we deal with have basements, and basements have limited scope of coverages. If I can get pulled it out of that and get into an X zone, I still have, basements I still have X zone, I still have limited scope. Basements always have limited, excuse me. I got off on the wrong tangent there. Sorry, my confusion. There's other considerations that you need to always consider, and I just want you to understand, these are just a few of the things that can affect it, okay? There's changes coming in this program through this reauthorization, and I noted on that. I want you to understand Biggert Waters, which is the Biggert Waters is the Reform Act, Biggert Waters Reform Act of 2012, is the act which took us and has expanded us to 5 years on the program. So we've been reauthorized for 5 years. In a nutshell, Biggert Waters is saying this, is they are pulling the federal subsidy out of the program, except for primary residences. Why is that important to a risk manager? If I've got buildings that are PreFirm, standard PreFirm buildings, meaning built before 74, built before the community started the program, and it's rated standard, not on a PRP, and not using a voluntary elevation certificate, that over the next 4 years, that subsidy's coming out. So I'm a risk manager. What am I weighing? Cost and benefit in my strategy. So if my cost is going to go up collectively 25% over the next 4 years, am I going to look at this difference? Yeah, of course I am. Okay? If I'm an individual and I'm being subsidized right now, and I buy that based on this cost, if it's going to go up significantly over the next 4 years, I might make, if I don't have a loan on the house, a decision not to buy. Okay? That's going to be one of our biggest challenges, is to keep what we have on the books. And that's what we need to understand, is a risk manager needs to understand what's going on with that, needs to be ready for it. The big things is take the subsidy out of PreFirm. The only other big subsidy in this program is something they call grandfathering. And if you were built to a specific zone in a specific height, right now we can capture that and then give you the rates as was in effect when you built. I mean, not the rates, they would in fact give you the rating mechanism that was in effect when you built. So I could have a building built in a X zone, and I can still get him that X zone rate when he's in fact in an AE zone. Okay? So right now, that's a form of subsidy. We're not getting the full risk premium. Bigger Waters said that since this act has been passed, any map change that comes in after that act was passed, okay, it's now a law. Since this law went into effect, which is July 2012, any map change after that, all risk within that map will be rewritten at their full flood risk, which basically effectively kills grandfather. So if I was in an X zone and its new map